Markets kicked off the year and the quarter on strong footings. The first couple of months of the year, in fact, was quite strong for markets, particularly outside of the US, posting very strong returns. The US lagged a little bit behind, kind of on two factors related to AI. On the one hand, the spending of some of the AI hyperscalers was coming into question whether that would be profitable over the longer term. At the same time, certain industries like software came under scrutiny for the disruption of AI against their business models. That kept US equities down for the first couple of months of the year. Now, things shifted quite drastically with the outbreak of war in the month of March. Oil prices shot higher, and from the perspective of markets, really that choking off of supply from oil from the Persian Gulf really was the primary concern. Led inflation expectations higher. Bonds that had been doing relatively well the first couple of months of the year saw yields move higher, so bonds sold off. Equities generally sold off across all asset classes. Commodities really the only beneficiary in this heightened geopolitical risk environment. So the beginning of this year, the first couple of months, we saw a continuation of that rotation away from US stocks within the stock market, particularly international markets. Emerging markets benefited from that big rotation, and we saw the US dollar continue to drop as well. So that rotation was certainly there. What was holding back US stocks? A lot of that had to do with AI. And really, on two fronts, you had the large cap AI players were facing some scrutiny around their spending on building out data centers. And then at the same time, we had certain sectors come under a lot of pressure from potential disruption from AI, and specifically the software sector is a great example there. That kept the US stock market somewhat subdued over the first couple of months of the quarter. Now, with the breakout of war in the Middle East, we saw things really converge over the month of March, right? So some of those high flyers, a lot of the recent gains in international markets and emerging markets, some profit was taken there, but it also makes a lot of sense given that those parts of the world are more reliant on oil, liquefied natural gas, from that region of the world. So you saw a little bit of that profit taking, some relative outperformance of the US as the quarter came to a close over the course of March. When we look out in other asset classes and fixed income, certainly yields came under pressure as inflation expectations put some pressure on yields. And again, we saw bonds sell off. Really, the one diversifier was the commodity complex, particularly across the energy complex, whether it's crude oil, natural gas, very beneficial to a portfolio. Precious metals, on the other hand, given some really strong gains over a number of quarters now, dating all the way back to 2024 for gold prices, for silver prices, we actually saw those sell off with the risk-off tone. So precious metals did not play that sort of defensive characteristic that it sometimes can, given really that it was, again, a source of profit taking as that broad kind of risk-off tone overtook markets in the month of March. The Granite portfolios were well positioned over the course of the quarter. The strategic positions that we have in broad commodities did benefit over the full course of the quarter, as well as with the flare-up of war in the Middle East. Really a benefit to the portfolio to have some of that broad commodity exposure. From an equity perspective, emerging markets, international markets, Canadian equities as well were positive contributors. When we think about tactically speaking, a couple of positioning changes over the quarter were beneficial. A tactical position directly in crude oil futures was a positive contributor. Within the US equity markets as well, we had positioned our sector positioning to favor resource sectors on the one hand, as well as more defensive areas of the market like staples, like healthcare, like real estate. All of that sort of sector rotation was beneficial to the portfolios as well. And then from a total risk perspective, we tactically underweighted international markets and went underweight equities early in the month of March and kind of pivoted that position into more of a relative value play where we're overweight the US and underweight international markets through the latter part of March. All of that was beneficial to the portfolio as well. The most important thing for investors to remember is during periods of heightened volatility, it's rarely a good time to make a drastic change to your investments. right? Some of the most positive days in markets actually occur during these bouts of volatility. So it's very hard to time the market, particularly when we're going through a lot of uncertainty. The best advice really is to have a strong financial plan and stick to that plan. Through periods of volatility, you really gain that benefit of removing the emotion, and ultimately that's what's best for investors through these sorts of periods of volatility.